If you keep a significant amount of money sitting safely inside a standard bank account, you have a financial cushion most people envy. You are disciplined. But when you hear coworkers talking about index funds and massive compound growth, a quiet voice starts wondering if your cash is falling behind while the market moves ahead. To see the actual cost of staying in cash, let's look at the math on a $20,000 balance. Leaving $20,000 in a typical 0.5% bank savings account for 20 years yields just $22,100. But looking at the 8% historical average return of the broader stock market, that identical $20,000 starting amount scales to over $93,000. The reason most savers miss out on that $70,000 difference isn't because they can't do the math, it's because investing involves volatility. Seeing your hard-earned numbers drop on a Tuesday afternoon triggers a survival response that makes most people run back to the safety of a bank. Today, we are going to build the lazy portfolio. This is a step-by-step system designed to capture that long-term market growth while using a structural safety net to manage the stress of market dips. Step 1 is building your financial fortress. Calculate your absolute baseline living expenses for a single month and multiply that number by 3 to 6. Take that specific total and move it into a high-yield savings account. This account will typically earn a steady 4 to 5% interest. There is a strict rule for this pile of cash. It is never to be invested in the market. It stays in the bank. This money acts as your financial shield. If you face a sudden medical bill or a job loss, you draw directly from this cash. This ensures you are never forced to sell your investments at a loss just to cover an emergency in your real life. By fully funding this emergency fortress first, you protect your long-term portfolio from the unpredictable chaos of your daily expenses. Step 2 requires a mental shift. We take your remaining funds and divide them into 2 entirely separate categories. The first is Bucket 1, your safety cash, locked in your high-yield account. The second is Bucket 2, your growth engine, which we will actively invest. The psychology of this setup works because Bucket 1 guarantees your immediate survival. Since your bills are covered, you can give Bucket 2 permission to experience normal market fluctuations without feeling like your life is at risk. This mental boundary ensures your immediate physical safety is never tied to daily market performance, making it much easier to stay invested during the red days. Step 3 is deciding what to actually buy. When you open your investment app, avoid the noise of individual tech stocks or volatile crypto coins. Instead, we apply a 70-30 split. This interface mockup shows the allocation. 70% of your growth money goes into a total stock market index. By selecting this fund, you instantly purchase tiny pieces of hundreds of the world's most successful companies. If one business struggles, hundreds of others balance it out, which eliminates the risk of a single company's failure ruining your savings. Then, as shown in this second input field, you allocate the remaining 30% of your growth money into a conservative bond fund. This bond portion acts as your shock absorber. When the stock market gets bumpy, these bonds tend to stay stable, which calms the overall movement of your entire portfolio. Using this simple 2-asset strategy, you capture the growth of the global economy without the need for ongoing research or daily effort. Step 4 is the most critical action for a lazy investor, removing yourself from the equation through app automation. You need to configure your app to make an automatic monthly transfer from your paycheck, which continually buys that exact 70-30 split. By locking in this setting, you remove the emotional burden of timing the market. You never again have to log in and wonder if today is a safe day to buy. Automating this system transforms investing into an invisible background process that builds your wealth while you sleep. You have now established both a protective cash shield for today and an automated growth engine for your future. Leaving all your money in a savings account is like storing seeds inside a massive stone tassel. They are perfectly safe, but over time they remain stagnant. They never fulfill their potential to grow. The lazy portfolio is different. You keep your safety seeds inside the castle, but you take your excess seeds outside the walls and plant them in the soil, exposing them to the elements. Because the castle protects you from immediate hunger, you can let time do its job. Over the years, those planted seeds grow into an orchard that can support you long after you stop working. Saving money provides peace of mind for today, but lazy investing allows your money to work harder so that you don't have to. If this approach makes the market feel more manageable, please hit subscribe, leave a like, and tell me in the comments, What is the number one fear that has kept you from starting your investing journey?